A stock you probably never held just made some people 4 times richer by lunch today. uniQure, ticker QURE, closed up 73.3% on volume. That was roughly 14 times its 30-day average. That is not a short squeeze, not a meme crowd, and not an accounting error. There's a specific, documentable reason this happened, and understanding it will change how you look at every biotech position in your portfolio. The real question is not why it moved. The question is whether anyone who bought it this morning made a rational decision or just got lucky. Let's be precise about what moved this stock, because precision is the only thing that protects you from drawing the wrong lesson here. uniQure is a Dutch gene therapy company whose lead asset is AMT-130, a one-time gene therapy targeting Huntington's disease. Huntington's is a fatal, inherited neurodegenerative condition with no disease-modifying treatment approved anywhere in the world. That market context matters enormously. When there is no existing standard of care, the FDA and investors alike assign asymmetric value to even preliminary positive data. What the market received on June 17, 2026, was updated clinical data from the ongoing Phase 1 and 2 trial of AMT-130. Specifically, longer-term follow-up showing that patients in the high-dose cohort demonstrated a statistically meaningful slowing of disease progression compared to natural history controls. The company reported that at 24 months post-treatment, patients showed approximately 50 to 60% slower decline on the composite Unified Huntington's Disease Rating Scale, a clinically accepted endpoint versus what the natural history literature would predict. Now here is where market structure intersects with biology. Before today, QURE was trading near multi-year lows. The stock had been de-risked by the market to a point where it was pricing in a high probability of failure. When the data came in, not just positive, but durable, meaning the effect held at the 2-year mark. That probability distribution snapped violently in the other direction. The 73% move is the mathematical result of the market repricing a low probability success into a moderate to high probability success. That is not hype. That is Bayesian updating happening in real time across thousands of order books simultaneously. Here is where most retail analysis goes completely off the rails. People see a 73% move and ask one of 2 wrong questions. Either, should I buy the dip when it pulls back? Or, is it too late? Both questions are almost entirely backward. The right question is, does the new information warrant a new intrinsic value that is at least 73% higher than yesterday's price? And to answer that, you need to think in expected values, not price levels. Before today's data drop, QURE was carrying roughly a 10 to 15% implied probability of AMT-130 reaching approval based on how comparable stage Huntington's programs had historically performed, which, to be blunt, is not well. A 10% probability on a potential blockbuster asset in a disease with no competition is worth a certain number. If that probability just moved to 30 or 35% on the strength of durable 24-month data, you would mathematically expect the stock to re-rate significantly. And 73% is not an unreasonable output of that calculation depending on your peak sales assumptions. But here is the trap. Phase 2 is not Phase 3. Huntington's has a graveyard of programs that looked compelling at 24 months and fell apart in larger controlled studies. The natural history control design, comparing treated patients to a database of historical patients, carries methodological limitations that the FDA has scrutinized heavily. Patient selection bias is a real variable. So the honest answer is this. The move is partially justified by updated probability math, but it also contains a meaningful speculation premium. Investors who bought before the data are sitting on a rational reward for accepting binary risk. Anyone buying at the open today is paying for optionality that is now priced very efficiently with no margin of safety. This is not financial advice, but it is exactly the framework every serious biotech investor uses to avoid buying euphoria and calling it a thesis. Every time a biotech moves 50 or 70 or 100% in a day, a predictable sequence plays out among retail investors. Some chase the open, get filled near the top, and watch it give back 30% over the following week. Others sit out, frustrated, and start looking for the next binary event to trade, usually with worse process and worse information. Both groups miss the actual lesson. Lesson 1 is about pre-catalyst positioning. The people who made generational returns on QRE today were almost certainly not day traders. They were investors who understood the AMT 130 data timeline, sized their position to survive being wrong, because being wrong was statistically the more likely outcome, and held through months of the stock doing nothing or declining. That is not luck. That is disciplined asymmetric risk-taking, which is a learnable skill. Lesson 2 is about catalyst calendars, biotech binary events, FDA decisions, Phase 2 and Phase 3 readouts, advisory committee meetings, are all on publicly available clinical trial registries and FDA PDUFA date trackers. They are not secrets. What separates informed investors from noise traders is the ability to evaluate the prior data, assess the trial design quality, and form a probability estimate before the event. That evaluation is the actual work. Lesson 3 is about position sizing and portfolio construction. A clinical stage biotech like uniQure, before today, carried real and substantial risk of going to zero or near zero if the data had come in negative. Anyone who had more than 2 or 3% of their liquid net worth in a single pre-phase 3 biotech was not investing. They were speculating without a risk management framework, regardless of how good the thesis sounded. The most sophisticated thing you can do after watching a 73% move is not figure out how to buy it. It is figure out how to have been in it, or a position like it, before the move happened. That means building a process, tracking catalysts, reading trial design methodology, sizing bets proportionally to both conviction and to the probability of total loss. The investors who do that consistently across a portfolio of biotech names, not just one home run, are the ones who compound capital in this sector over a decade. Everyone else donates their money to them. So here's where we land. uniQure moved 73% today because durable 24-month clinical data on AMT 130 forced a violent Bayesian repricing of a program the market had largely written off. The move is partially rational, partially speculative premium, and chasing it without a pre-built process is how retail investors consistently transfer wealth to institutional traders. The real question this raises is the one we will answer in the next video. How do you actually build a watch list of pre-catalyst biotech positions before the move happens? Subscribe so you do not miss that breakdown.